Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey, and this week I'm joined by Zach's stock strategist, Jeremy Mullen, who's also the editor of Zach's Counterstrike service. And Counterstrike is kind of an interesting service because it's designed to be both long and short stocks, and not all of Zach's trading services are designed to be like that. So I think that's interesting. And today we're going to talk about the short end of that kind of strategy and basically how do you short stocks? Why would you want to? How do you do it? All that stuff, because Jeremy's kind of the expert on it. And I do have to say, in full disclosure, I have never shorted a stock. I don't have any intention to short one. I don't have any desire. I don't want to. I get asked this question all the time on Stock Twits whenever I tweet out about a stock that a lot of other people are shorting. They're like, "We know you're shorting it, Tracey. Tell us now." And they don't believe me when I tell them I'm not doing it. But that being said, I do know that the shorting strategy is used by a lot of people, a lot of traders, and they love it. And you can make money off of it. So that's why we have you here, Jeremy, to explain how shorting works, why I would even want to do it, and basically how to start doing it. So you and I kind of chatted a little bit about this since I'm clueless, I guess you could say, and how this even comes about. But basically, shorting, I should think of it as like a similar way to going long. Obviously, you're just taking the opposite side of the trade.
That's correct. Thanks, Tracey, for having me. Yeah, basically, when you short a stock, you're just betting it's going down. Now, people have a lot of hesitancy to go short because they don't really know what the upside risk is, and that's it's a great approach to have. Really, when you short a stock, if you short it at 50, it can go to 1,000. If you buy it at 50, it can go to 0. So you essentially know your risk. Now, when you short a stock, it is important to obviously grasp what kind of risk you're going to have. So, and there's a bunch of different approaches you can take to that. Basically, if a stock let's say it made a high of 75 and it came down to 60 and you think it's going down. Well, if it comes down, if you short it at 60 and it goes back up to 75, maybe that's the point you kind of want to be your 0. So that's the point you'd want to get out of that stock.
Okay. Let's talk about a few different scenarios because I think this might explain it more to people because this is how I always think about it. And I feel like there's a couple different basic setups for why you would want to short a stock. Like you're already telling me like because you think it might go down, but these are the scenarios where you think it would go down. So this is why you want to get in there. And one of those scenarios, I think we've seen a couple of these happen in the last year or so. And these are kind of the event-driven shorting things. And let's start with one that was big time in the news. And I kind of like this one because it was lumber liquidators.
Right.
And people might remember that last year, in about February of 2015, suddenly word came out, they make the hardwood flooring, and word came out that they were going to be on 60 Minutes, which is never usually a good thing if you find out you're going to be on 60 Minutes. And no one knew what the segment was really going to be, but the company did say, we were approached to give a comment. Our CEO talked with them or whatever. And again, this wasn't good. And then since then, the stock has plunged. We know a lot has come out about their flooring that's made in China, blah, blah, blah. But that is an event-driven kind of scenario. How would I have shorted lumber liquidators?
Sure. Well, Lumber Liquidators was actually trading over 100 before any of this hit. And then some of the fundamentals kind of started to get shaky. And we saw a pullback to the 75 area before this all started. And the 60 Minutes thing came on, and there was all these kinds of rumors that came out about the flooring giving cancer, and nobody's ever going to buy this again. And that obviously is going to hurt whatever kind of sales you had. So initially there was a dump in the stock. It came down to about, I think, under 60 before it had a nice little bounce. Now, if you're skeptical that they're going to recover from this kind of situation, you want to look for a great place to short that stock. Now, I think it came back up to around that 70 area before more news hit the fan.
Yeah.
So if you were kind of fading, what we call fading when the stock's coming up, taking short position into that kind of slow up move before it fell, you would definitely profit when that second round of news hit. And, the stock tanked all the way down to 25 after that happened, and it continued. Now
Yeah.
it's trading, at 14 after going to 10.
Okay, so now the shares have come all the way down. It has rebounded in the last month. I looked this up. It's up 24% in the last month.
Right.
It hasn't reported its next earnings report. That's still to come. What do I do now? Is this kind of a scenario where I wouldn't want to short, or after it bounces big off of that low, is this a prime setup for someone to go in there and short it into this,
Well, I wouldn't necessarily be looking to short here. There is not much room on the downside. Like I was talking about earlier, you short at 50 and it goes to zero, you make those 50 points. Here, it's at 14. Now, you could make a big percentage move if it goes back down to 10. But your risk reward here is not as great because there's a lot of people short the stock, and there's potential for, if there's good news to come out, that this stock could go right back up to, let's say, the $25 area. And you don't want to be caught in that short squeeze because it'll happen fast.
Okay, so this is off the table for shorting.
For me, it is.
Okay.
The short I think happened when that first kind of round of news to see if this event-driven news will keep on creeping into the stock and hurting potential sales. And then the second round really was that 25 area before it went down to 10. Now we could see that 10 revisited, but the risk reward kind of scenario is not essentially one I want to take at the moment.
Okay, so on event-driven episodes, you definitely obviously want to get in as early into the event as possible.
Sure, if you believe that event is going to be kind of a catalyst for the company's business is basically being hurt.
Okay, let's look at that through another scenario then.
Sure.
Chipotle.
Right.
That was also an event-driven decline in those shares because last fall it started coming out about the E. coli and they had issues at some of their stores. They had to shut down some. Stock got slammed down, and then they had a small rebound, but now they're down 15% in the last month again. They did give an update on their sales. They were worse than expected. They're spending all this on marketing. For right now, we don't have another update, so we don't know how good or bad it is. People are just going into the stores and taking pictures of
the lines,
right. Or the lack of lines and saying it's bad.
Personal channel checks.
Yeah. So this one, unlike Lumber Liquidators, seems to still kind of be in the middle of the story.
Yeah.
But have we already passed the time when we needed to short this one too?
Well, I think, there's room probably further down here. If we see a bounce, I might consider it a short here, but this might happen really fast to where the short kind of chance goes away. When the stock bounced to 400, we saw a nice bounce. It just kind of, had fallen too far too fast, got a bounce. They came out with earnings, didn't seem as bad, and we got a bounce up to the 525 area. This is where I was looking to short. Not only did the estimates continue to fall, it was a Zacks rate number 5.
Yeah.
I also saw a Fibonacci level, which is something that's kind of confusing, but I will.
The
definitely,
Fibonacci.
Yes, I talk a lot about in the office, and I will detail, in the Counter-Strike newsletters and try to teach people about that. But it came right up into that level, and I was looking for a short there, and it's 75 points, actually more 85 points lower from that level.
Yeah, it's really
at
fallen.
440 now. So. Looks like we're going to retest that 400.
Well,
level.
that was just going to be my next question. Would I be looking? I'd be looking at that. But on the risk reward side, there seems to be still, if you're shorting it, some rewards still left on the downside here.
Yeah, definitely. So if it bounces back over that 450, you could push it here, but I'd be looking to fade again. I kind of like to fade these moves with an out against the 500 for a 350 kind of target. So what I'd be looking for, that 400 level to flush. 350 is kind of the area of that Fibonacci target, so that's why I'm kind of looking for that. And I would definitely want to be covering and possibly maybe looking to flip the trade, so go long if the situation starts to change. So if these lines start getting longer and the estimates starting to tick up, there might be a chance to cover your short, profit on it, and possibly even go long on that at that 350 level.
Okay, let's switch to another scenario that's not event-driven. And, I know people love to play shorts into earnings season. I always see it on Stock Twits. This is where I always get, when they accuse me, like, oh, you're short it into the number, they always say, because you're expecting some bad news. And that's how you can benefit. Is it smart to short into the number?
Yeah, you just have to realize what you're risking. I mean, you've seen these squeezes happen, and it's hard to get out, especially if you're not trading after hours. You could wake up in the morning and the thing's up 10, 15% on you. So if you do short into earnings season, what I would recommend is hedging your bet and maybe buying call options against your short position. That would help you reduce the amount of risk you're taking. And if you're right, the call options you just lose the premium. So you're gonna, if it goes the distance that you think it's going to go, or the move is big enough, the money you lose on your call option won't even matter.
Now, do I want to be in stocks that have a big short position already if I'm shorting, or do I want to avoid those?
Well, sometimes that's really good, because obviously the crowd is betting that this company is not doing well, and therefore when they have earnings, the stock will go down. However, this is how the majority of short squeezes are formed. There's too many people short the stock. The numbers come out and they surprise everybody, and everybody has to get out and cover. And some of them even want to go long now because the story has changed, and they get bullish overnight because, they've been studying this company and some kind of fundamental trigger has happened. So sometimes following the crowd is not generally the best thing to do.
Okay. Let's talk about an example of one of these kinds of scenarios. Specifically, let's talk about LinkedIn, because that was kind of shocking when that happened. That one had a big plunge after its last earnings report, even though it beat. So all that looked good. But, shares fell like almost 50% because guidance was on the light side. But as a trader, why would I have been shorting LinkedIn ahead of that?
Well,
can you?
Well, of course, yeah. You could definitely have shorted it before that. The reason to get short is that you basically think that the business was kind of fundamentally flawed and that an earnings report like this would happen. Now, technically, at that point, I didn't see this coming. There's nothing in the charts that I saw get short this stock. As a matter of fact, it looked like kind of a stronger chart. It had pulled in from 250 to the 200 area, but there was no real reason to say, this thing's going to dip all the way to 100 overnight. And that's exactly what happened.
So there was no Fibonacci
I didn't see
signal
like
on
that.
this or anything?
Sometimes that's irrelevant. And this is one of the cases where there was nothing technical that could hold this stock up. There was no support levels. Everything was taken out. It went down to 150 after hours, and the very next morning it was trading at 120. And I believe it clipped 110 before bouncing.
Now, what do I do going into this earnings season if I think LinkedIn is still going to disappoint?
Yeah, so we talked about that 100 level clipping, and we saw a bounce to 125, which is a 25% move, which is a great bounce. So if you bought that, congratulations, that was 25%. Now, but what I saw is a halfway back from that 150 after hours level from right after earnings to the 100 area at 125. Now, going back to a Fibonacci thing, there's a setup for a target under 90. So if you're looking to go short this, you have a 20-point move here from 110 to potentially 90. And then if it went back over 125, there's probably something fundamentally that changed that maybe what they were expecting when the stock was at 200 is coming back in and they want to buy it back.
Okay, what about a stock like Michael Kors? This one plunged in May 2015, and then shares this year, they fell pretty substantially. No, everybody thought nobody's buying handbags, and that aspect is done. Accessories are over. But shares have really rallied off of the 2016 lows. And I have a question about shorting a stock that appears to have rallied too much. Is that a good time to get in there and short it if you think like it's just overbought now?
Sure, this is part of that fading aspect. You think that, this was it was oversold earlier, and you had this massive bounce off an earnings report that was great. And that was a massive short squeeze. We went from 40 to 50, pulled back a little bit, and it went almost close to 60. So if you're still bearish on this company, that's a perfect time to fade it and start your short position. And now that it's come down to 52, what you're kind of looking at is, all right, I got my position on because I faded into it. I'm going to hold into the next earnings report to see it come back down. Now, there's a lot of other people probably doing that too who were initially short that short squeeze, and they're doubling down. So if Coors comes out with another solid report like last time, we'll see another squeeze that'll probably break that 58 level. That's when you know you have to get out.
Okay.
That's basically your zero. So you can look at this as a $51 stock here, and your out's 58. So you actually have a 7-point risk. So it's like you're buying. People should look at it like they're buying a $7 stock, and it goes to zero. Basically, that's their risk there.
Okay. Now, are there certain sectors that more short sellers focus on versus others? Are they more into the tech or, the high growth names? I would assume, I mean, how many people are short selling, GE or one of those kinds of stocks, right? And does volume matter?
Yeah, those like the bigger companies, there's probably less short sellers. The high growth, high beta stocks that have just move a lot and they're way overvalued. Those are what the short sellers are going to look out for. They're going to look out for that. Volume doesn't matter, but yeah, they kind of want to have some nice volume in there because if you short a stock and there's not a lot of volume and you're wrong, it's going to be hard to get out of your short position because you're going to be one of the only people, bidding that stock up, and you might be dealing with a point or 2 point spread. Trying to take that kind of offer can be difficult, and you can just lead the stock higher. So like volume is really important in getting into a short position.
Okay, so it's a little bit more difficult to short the very small cap stocks, I would think.
Right, yeah.
For that reason.
Those low volume thin stocks, right. But you don't necessarily want to go big unless you're making an overall macro call on the economy. So if you're shorting something like AT&T, you're kind of saying, okay, there's going to be problems in telecom, there's going to be problems in the macro economy, not with the individual company itself. Whereas you can use an example like GoPro, a year and a half ago when it was flying high to 90, you're like, this is overdone. Come on, guys. Let's short this at 90. And, people were rewarded for that.
Yeah, definitely. It sounds like a lot of those kind of glamorous consumer names you are prime targets for shorting, like Fitbit
or Shake
and
Shack too.
Shake Shack,
did
a lot
the
of the
same kind of
popular-
move GoPro did, just hasn't come down as much. So yeah.
Okay. What do you think about using the shorting ETFs as a method? Obviously, it's different than shorting stocks, but I guess if you're making a bigger, statement on the overall economy or something, do those work?
Yeah. I mean, those are macro calls too. I don't look at those as investments though. Those are more of just a trading vehicle. So I use them on a day-to-day basis. So if I think the market has some weakness and is going down over the next 3 days, I want to be long this triple leveraged bearish ETF. So those are fine to use. Just realize that especially the leverage ones, over time they generally come back down. So it's not a smart move to kind of hold those for more than a month. Really, I would usually advise against that.
Okay. What about just in general in your portfolio? Obviously this is determined by people's risk, tolerance and all of that, but should I be, just shorting one stock? Should I have half my portfolio in shorts? Does it, obviously if you like shorting and if that's fun for you, should you be more focused on that? I don't know. I mean, these are just questions since I never do it. I know people want to know, how much percentage of my portfolio should I be trying this method?
Yeah, it's whatever is right for you and what you're comfortable with. But, for me, it's kind of how I'm viewing the market. So if I'm bearish on the market, I'm probably going to be short a majority of the stocks I own. If I'm pretty bullish, I'm probably not going to be short any or maybe a couple that I see it might be overvalued. But yeah, overall, it's kind of just how you view the market. That's how you adjust your portfolio.
So in January and February of 2016, when we had the big sell-off, you would say you had the propensity then to be more on the short side.
Yeah, I mean, I was mostly short when we had that big bounce. I was looking to fade into that bounce, and yeah, I was getting short a lot on those instances. And then, but you have to be really careful because this second bounce, obviously, which I was kind of bearish and not thinking we were going to go to those the January highs. I was like, well, I'll get short. So when it went above the January highs, like I was forced to change my view. I was forced to kind of cover. That was my zero, right? and you don't want to go to negative, right?
No.
You want to go to negative 5 or 10 or 15.
No. Now, does shorting require more attention to the stock market than going long?
For me, it doesn't. For some people, it might, just because you really don't want to let a position go against what you're willing to risk, because there is that unlimited risk theory that, if you missed a day and the stock went past that, or missed 2 days and it keeps going because other short sellers are seeing the same thing you are and they're taking the stock up higher, that's not good. So I would recommend, if you can't watch the market all the time, to just use stop orders.
Okay.
And for a short sale, the stop orders, all you're doing is put in a buy stop order. It's the same as a sell stop order. It's just on the reverse side.
Okay. Or I can, get into something like your Counter-Strike service.
Yep.
Just follow along with whatever you're doing.
Right, I can watch it for you.
Right, because I feel like this is why I've never done it, other than I have used the ETFs before, but I've never done the individual stocks because I feel like it's so time consuming to know the Fibonacci levels and everything else that's going on, and the news about the company too. I mean, you have to keep abreast on everything that's going on, when they're going to have their sales come out, what if they pre-announce and all of that. So yeah, I'd rather I let someone else do it for me.
Yeah, I'm a big market watcher and news watcher. So yeah, I'm the eyes and ears for anybody who's interested in that, for sure. And, it's not just short selling stocks. I'll be going long too. If I think the market's at a buying point, I'll probably cover all my shorts and flip them all to longs, or I'll be watching stocks that I want to go long.
Okay, great. I'm looking forward to seeing how that service works, and
me too.
Seeing all the shorts from afar. And if you want to know more about what Jeremy is going to do with Counter-Strike, you can check it out at Zacks.com. You can find it there, and you can also check out any of his articles. Do you write shorting articles too? Have you written anything?
I've done some shorting articles.
Okay.
Actually, if you go back to when Chipotle and LinkedIn were at the 125 and 520, I actually had an article there where I pointed those stocks out.
Okay.
So far, it's been pretty good.
Yeah, check out all that. You can find Jeremy on Zacks.com, and also on Twitter. You're at Jeremy Mullen, aren't you? Over there?
JMullen9.
JMullen9.
Yeah.
Where'd the 9 come from?
Yeah, it's like
Just
first
random
apartment number in college or something like that.
Interesting. So you can find him over there too. And my articles are also on Zacks.com. They won't be about shorting, as we just discussed, but you can find those over there. And if you want to listen to any of our other podcasts, you can check those out on iTunes, and we're also on SoundCloud. And of course, you can find any of our podcasts on Zacks.com. We've done over 25, or this is 26 or 27 for the podcast. 27, I'm being told by Danny, our technician, helpful recorder, who's here in the studio with us. So 27 podcasts. So there's a lot you can catch up on there. There's some really good information about various sectors, various areas around the world you might want to invest in. This is our first one on shorting. We might have to do more on this as it goes along. And I'll be watching the service so I can try to learn some more. So I'm not totally clueless. But for anyone who doesn't know anything, this was good, I thought. So thank you, Jeremy. And I'll be back next week for more here at Zacks Market Edge.